Jason Regis,
My name is James Cumming.
and we are Over the Hedge Portfolio Management. This are our main cards.
It's me.
How's it going, Pank?
That's good.
Good.
We killed that.
Here at Over the Hedge Management, we began our research process by looking at different stocks and different ETFs on large finance websites. Some, for example, would be Yahoo Finance, Google Finance, CNN Money, and the Bloomberg Terminal Lab. We wanted to create a portfolio of primarily ETFs, and we also just picked one stock. During our security selection process, we wanted to look at specific asset classes and hopefully find different ETFs that could hedge out each other in those certain classes. At the beginning of the semester, we were given over $100,000 to split between $50,000 for long and $50,000 for short.
So on the screen right now is our initial portfolio holdings report. It shows our long positions and our short positions. This portfolio is made up of primarily ETFs with one stock. The stock was Magellan Midstream Partners with the ticker symbol MMP. You can see a column with our initial investment amounts and then the total purchase price of one share of the ETF. In the next column over, you then see the amount of shares we initially purchased. The following column has the beta figure versus the SPY index that we pulled from the Bloomberg Terminal Labs. This basically shows the volatility of this individual security versus the SPY index, which is supposed to represent the overall market. The final column shows our weighted beta, which is just the beta versus the index figure multiplied by the weight of the security out of the entire portfolio. And this is done by just dividing the initial investment amount by the total dollar value of our portfolio. So you can see that we have a good variety of holdings here. We've got 8 long positions and 7 short positions. We end up with a net beta exposure of 0.3797. This is our table of expenses. It basically shows the expense ratio associated with each ETF, and the expense ratio tells you how expensive it is to actually own this investment, how much bottom line return will be taken away just for owning this thing. As you can see, MMP, the one stock that we held, has no expense ratio. ETFs generally have expense ratios between 0.3 and 0.4. As you can see, we actually had one, EZU, which it had an expense ratio of 0.48. That was a pretty high expense ratio, but this oftentimes correlates with a higher trading volume and tighter spreads, which are desirable traits in ETFs. So the final column in this sort of shows the representative quarter expense that we would have based off the total annual expense of holding our investment. The annual expense of holding our investment was simply found by multiplying the expense ratio by our investment amount. This is our table that shows the batting average and the holding period return for our portfolio, which really it sort of measures the overall performance of our portfolio. As you can see, we had a pretty poor return at negative 6.82%. This kind of came from picking some short positions in ETFs that ended up doing very well. And we had some high weightings in these ETFs that did well, and that really brought our returns down. Initially, we had thought that our entire portfolio was performing pretty well, and that was because on Google Finance, all of our securities were put in as long positions. So we had sort of false hope throughout the semester that we were in the green, when in reality, we ran it through your tracking spreadsheet and we were far in the red. So as you can see, we had some pretty strong performance here. We just didn't make all the right choices. So we made 8 out of 15 right calls with our securities within the long and short positions, and that's 53.33%. So that's over 50%, and that's what we had hoped for. We'd hoped to get 50%, so we made that benchmark. So the weighted return basically is just the total return figure generated by Bloomberg multiplied by the weight of the security out of the portfolio. And then the holding period return is a similar figure, but in the case of our short positions, you can see that the stocks and the ETFs that performed poorly actually improved and gave us, returns in the green. And then the stocks and ETFs that performed well in our short positions actually brought us strong negative returns. And IYT performed so well, we had such a heavy weight in it, that we actually saw negative 2.73% return from that ETF specifically. So this is a graphical representation of the table that I basically just showed you, plus or minus a few things. It shows the overall performance of our portfolio versus the index. In this case, the index is the SPY. On the right part of the screen, you can see some figures that we pulled up from the tracking sheet. The holding period return on the portfolio is negative 0.678%, very close to the figure that I calculated in the table previously at negative 6.82%. The holding period return of the index was 2.96%. And these are some pretty strong changes for a 3-month period, you know, starting our portfolio off at September 16th and finishing off at December 2nd.
Over the past 3 months, we fully immersed ourselves in the real world of financial management. We gained a lot of knowledge from the information that we researched, but we gained most of our knowledge from the mistakes that we made. We didn't look at correlations much between the ETF pairs. Instead, we looked at different dollar allocations for sectors to reach a target risk that we wanted. We had huge weightings in certain securities. Some acted opposite of what we expected, which in turn killed our returns. We found differences in every website that we use, which now helps us understand the cases that we had to read throughout the semester about beta calculations. We should have really done more research on all these ETFs, and if we invested real money, we would have identified security relationships and created a less risky portfolio in the long run.